Hello, this video is about the drivers of stock price, particularly in the business strategy game. I'm your professor, Dr. Stephen Haggard. First, let's talk about what a stock price represents. In finance, we say it represents the present value of all the future dividends that the firm pays. Now, you might say, what about the price that I would receive upon selling the shares? And the answer is, if we push that price far enough out, when we take the present value of it, the present value is very near zero. So all we have to do is think about the present value of all the future dividends. And so I'm going to use a very special case here, just to illustrate so you can understand what drives stock price. And that special case is the constantly growing dividend. Now, you may recognize this as a growing perpetuity formula in disguise, and that's exactly what it is. The formula says that the price of the stock today is equal to the dividend to be paid at the end of the period divided by the required return minus the growth rate. Now keep in mind that required return and growth rate, they both need to be in decimal form in order for this formula to work. So let's see what that means for what different changes in dividends, required return, and growth mean to share price. First of all, let's discuss the relationship between dividends, net income, ROE, and EPS. Please recall that dividends are simply the dividend payout ratio multiplied by net income. If you're unfamiliar with dividend payout ratio, it's merely the proportion of net income that the firm is paying out as a dividend. An ROE is net income divided by total equity. EPS is net income divided by the common shares outstanding. And so therefore, if we hold everything else constant, and that's what ceteris paribus means, if we hold all else equal, greater dividends are related to higher ROE and EPS, because we're going to hold that dividend payout ratio constant. Therefore, as net income goes up, dividends go up. And because we're going to hold total equity and the number of shares outstanding constant, as dividends go up, net income is going up, and ROE and EPS are also going up. And so this is how we see the relationship between ROE and EPS and stock price being positive. Once again, if ROE and EPS are higher, therefore the stock price should be higher if we hold all of these other things constant. Now let's talk about required return. We know that the greater risk you take, the more reward you demand. And that's what that little r stands for, is return, and that is your reward for taking risk. And so we can see that a bigger R, representing a bigger risk, would reduce stock price because we're dividing by that. And as you divide by a bigger number, you get a smaller number. So all else equal, higher risk means a lower stock value. Now, in the business strategy game, everyone is in the same industry. And so how would your risk be different from team to team? Well, the answer would come first of all from your financial leverage. Teams with greater debt would be riskier. And how can you identify that financial risk? Look at your credit rating. The higher your credit rating is, the riskier your firm is. And the other way would be through operating leverage. Now this isn't as important in the business strategy game, but it's there somewhat, because you can upgrade your equipment and therefore incur a fixed cost to lower your variable costs. So let's talk about the impact of growth. Because you're dividing by R minus G, as G gets larger, the thing on the bottom gets smaller, and as you divide by a smaller number, you get a higher number. And so greater G means an increase in price. So if you have two otherwise identical firms, the faster growing firm will have a higher stock price. Sometimes students say to me, wait a minute, we have the same ROE, we have the same EPS, and we have the same credit rating. Why is our stock price lower? And I tell them, it's because your firm is not growing as quickly as your competitor. So what's our conclusion? There are many factors that determine the stock price. Do not get focused on one to the exclusion of all others. One thing I see students do is to repurchase stock to decrease their equity and the number of shares outstanding. And that boosts the ROE and EPS, but they might be starving themselves of the capital that they need to grow, thus cutting into their G. Or if they are just filling in for that money using debt, they may be increasing their firm risk, increasing the required return, both of which can hurt their stock price. So you have to be careful and not focus on only one driver of stock price to the exclusion of all others, because doing so is a recipe for disaster. And finally, I would like to remind you, as I do in all of my BSG videos, to read the Flippin' Player's Guide. This is the best piece of advice anybody could give you as you play the BSG. You must read the Player's Guide.